This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's continue with our revision of the basic preparation of financial statements that we've seen in financial accounting. So in the previous chapter, we went through and looked at how to prepare a statement of financial position and a statement of profit or loss from a trial balance, didn't we? We also supplemented that at the end with a little bit of the preparation of a statement of changes in equity. They will be examined at some point within the exam in section C, one of those individual company style questions. The next section that we're going to look at now is all about your cash flows, which, yes, you've seen and you've had to prepare them as part of some of the questions in financial accounting. So the likelihood of having to prepare a statement of cash flows is minimal, but that doesn't mean to say it won't be examined. It has been examined in the past. It doesn't get examined frequently, so you run the risk of ignoring it and it coming up in the exam. Okay, so you just need to have that basic financial accounting knowledge, and if you've got that, then you can apply it in your financial reporting exam and do reasonably well within the question. So this session is effectively just going through and revising what we've seen previously. Okay, so what have we got? We've got the pro forma statement of cash flows. Now remember, the statement of cash flows is effectively made up of 4 separate sections, isn't it? You've got the right at the very start, your cash from your operating activities. So that's from your day-to-day buying goods and selling goods. You've also got as well the cash flows from your investing activities. So in financial accounting, you'll have invested in property, plant and equipment. In financial reporting, it's just a step up in that you don't just invest in PPE, you can invest in intangibles, you can invest in financial asset investments as well. So there's an extra little bit that you may possibly need to think about, but we'll worry about that when we get to intangibles and financial asset investments in later chapters. So as well as operating and investing activities, you've also got the cash flows from your financing. So looking at how an entity raises money to finance the investment in the PPE. So here we raise finance via debt or equity. So you've got the issue of shares, the issue of debt, and then you've also got any dividends paid and any payments that are made to repay off that debt. And then what you've got at the bottom, I refer to it as the 4th section really, is the change in your cash and cash equivalent, isn't it? Okay. And I think that's where we're better to go through there and start with, because that's going to be the starting point if ever you have to go through and do a question. Okay, it's usually the easier marks to go through and get. Okay, so when you're going through there and looking at your cash, you've got your opening and then your closing balance, and then we go through there and look at the movement from the opening to the closing. Okay. Bits and pieces just to note, cash, it is nice and simple. That's there within your current asset section, isn't it? Cash and cash equivalents. Well, the cash equivalents are effectively your short-term, highly liquid investments. So there's an assumption that we will be liquidating those investments potentially within 3 months. Okay. But short-term, highly liquid investments, they go in there as a cash equivalent. So even though theoretically it's not cash that you have at the bank, because it can be liquidated so quickly, it effectively is a cash balance that you have on hand. It's an on-hand deposit. Okay, so typically look in there, maybe government bonds or gilts or something like that within an exam question. And then what you've got there, be careful, is an overdraft. Okay, because cash is a positive balance and that will be within your current assets alongside any cash equivalents. But just be careful, your overdraft will be in your current liabilities, won't it? Okay. An overdraft is an amount that you owe back to the bank, so therefore we treat it as a negative cash balance. Okay. And I just like my little working that you've got up there, because if you then put that overdraft in a negative figure, in a bracket, you can then total up the cash equivalents and the overdraft, you can look at whether or not that overall total balance is increased or decreased, and that will then give you your movement, won't it? And it's then that movement that goes through there and appears, is it there at the bottom of your statement of cash flows. Okay. You've then got the opening cash and cash equivalents and the brought forward, the closing cash and cash equivalents. Copy those figures in, and that should be some pretty straightforward marks. Okay, excellent. So bits and pieces just to go through there and have a look at the statement of cash flows, and having a look there first of all at the operating activities. Yes, that's the cash inflows, the outflows from the day-to-day operations. But you look at that, what on earth is going on? It's always struck me as being slightly odd that we start with a profit figure, okay, and then we reconcile that profit figure down to your cash generated from operations. Okay, so we need to turn that profit figure into a cash figure. The method that this is using is the one that you are likely to be examined upon, which is the indirect method. Okay, whereby we reconcile the profits to a cash figure. The direct method just effectively looks at the cash flows coming in, the cash flows going out with regard to your day-to-day operations. So figures for cash sales, cash received from credit customers, cash purchases, cash payments to credit suppliers, and any other day-to-day cash expenses that you have within the business. Okay, but the focus here is on this indirect method. It's very strange. It's complicated. It's confusing. You're probably saying, it's not, Chris, I can do this. I've done it in financial accounting. Fine. But remember how challenging it was when you first started off. Okay. Yeah, it takes a bit of a while to get your head around it. Imagine for the users of the accounts. Well, it's just going to be crazy, isn't it? Really challenging. Okay. So what have we got? Well, it's odd in that we start with a profit figure, but we're looking at profit from operations, and we don't even start at profit from operations, do we? We start at profit before tax. What? Why are we starting at profit before tax? Doesn't matter. Okay, that's what the standard says. So where we're starting off effectively here, if you go back a few chapters into the statement of profit or loss that we had earlier, we're starting here at your profit before tax, and we want to get back to our profit from operations. That would be a better place to start, wouldn't it? So in order to get from profit before tax to our operating profit, we need to make adjustments, don't we? We've added in my investment income to get to profit before tax. We've deducted our finance costs to get to profit before tax. So if we want to work back up in effectively working in reverse, then what we need to do is we need to add back in the finance costs and deduct the investment income, and that will go through there and give us the profit from operations figure. So those three figures there combined, taking PBT, adding back finance costs, deducting the investment income, will give us our operating profit figure from where to continue on. There we go. So then what we need to go through and do and deal with is deal with what are referred to as your non-cash items. So items that increase or decrease our profits, but don't have the same cash effect. So if they've decreased our profits, there is no cash outflow. If they have increased our profits, there is no cash inflow. Okay, so the key ones that you've got there are depreciation and amortization, both of which are expenses, both of which are accounting for items under the accruals concept. There is no cash element to the transaction. So therefore, it is reducing our profits, but not reducing cash. If it's not reducing cash, we therefore need to go through there and add that back in, don't we? So any depreciation expense, amortization expense is added back. Likewise, a profit or loss on disposal. The profit or loss itself is a non-cash item. Yeah, it's just looking at the difference between the proceeds and the carrying value. We deal with the cash aspect later within our investing activities. Here we're just looking at the fact that we've made an accounting adjustment for the profit or the loss, and that is non-cash. So if there's a profit on disposal, that would have increased our profits, but not have increased our cash. So that profit on disposal is deducted, isn't it? If there is a loss on disposal, that will have reduced our profits, but will not have reduced our cash. So to get rid of that loss effect, we need to add it back in, don't we? So you've got to be really, really careful there in terms of the additions and the subtractions. If you got a profit, you will deduct it. If you had a loss, you add it back in. Okay, practice. You then get to what we refer to as the working capital balances. So inventory, receivables and payables, and how they have impacted our operating cash flow. So if you've got an increase in your inventory, it means you've spent more money, doesn't it? So we have less cash and therefore a cash outflow. If receivables have gone up, that means you've gone through there and not received the cash from your customer. And therefore we now have a bit less cash, don't we? The sales have increased because our receivables have increased. That means our profits have increased, but we haven't got the cash in because the receivables themselves have gone up. So that increase in receivables needs to be deducted from our profit figure. And then likewise, if we have an increase in our payables, bit easier to get your head around there. An increase in payables means that we've gone through there and not spent that money. Okay, we've just used some short-term free credit. We've not spent the money, so therefore the cash balance is increasing. Okay. If there was a decrease in inventory, receivables and payables, it would just all switch around. Okay, that's the thing that you need to remember. Just be careful. There are other items that impact your operating activities. So maybe any changes in prepayments as a change in an asset. So similar to inventory and receivables. Change in accruals. So again, similar to your change in payables. And then also as well, we may have a provision, which we'll touch upon it in later chapters. Okay, they are extra bits within financial reporting that you will not have seen within financial accounting. Okay. You've then got the mandatory payments of interest and tax, both of which will require a separate working. Okay. And those workings are just a couple of pages over. Okay. So what you've got there is you've got your interest payable. So remember, that is a liability, isn't it? So you've got your opening balance on the credit side, the closing balance on the debit, ready to bring forward on the credit next year. You've got that finance cost from your statement of profit or loss. So you debit the finance cost in the statement of profit or loss and credit your interest payable. Balancing figure is to the bank, and that's what then appears within your statement of cash flows, because you credited bank, debited that liability. The cash payment has reduced the liability. Similarly, you've got your tax payable balance, help you work out your tax paid. Again, just be careful because there's bits here that we're going to introduce, even though we've not introduced it as an accounting standard. Because normally what we've done is we've just taken our opening and closing tax payable balance. So to you and I, that's our current tax. So again, opening balance on the credit side, as you have a liability, closing on the debit, as that is then ready to bring forward next year on the credit side. The new bit that you've got, which we'll ignore for now, is your deferred tax. If you have a deferred tax liability, that will need to be incorporated too in the same fashion. And then once we've done that, you've got the tax expense, which debits the statement of profit or loss, credits our tax balance, and then the balancing figure is to your statement of cash flows, your cash payments. Okay, credit bank, debit your tax payable. Okay, there we go. They should be reasonably okay T accounts to get yourself accustomed with. If you don't like T accounts, your choice. Okay, you can go through and do them in an other addition and subtraction way, but once you get to SBR, Strategic Business Reporting, your old P2, I think it really helps to understand T accounts. Okay, whenever you're doing a cash flow question there. So that's my operating activities. Investing activities. We've got there. Remember, it's to do with your PPE, or now as well intangibles and financial asset investments. What we've got there is we're going to buy them, so there'll be a cash outflow. We'll sell them, there'll be a cash inflow. And then if you have any investments, you might have investments in debt, so you'll receive interest, or investments in shares, you will get some dividends received. Okay. So a couple of pages over, what you've got there is you can see the property, plant and equipment T account. Remember, PPE is an asset, isn't it? So the opening balance is on the debit side and the closing balance is on the credit side. Okay. Again, the way in which we work it is that you would have the balance from the SFP. So that is shown as the carrying value, isn't it? Being the cost less the accumulated depreciation. You've then got the depreciation, which reduces the carrying value. So you are crediting the carrying value because you are debiting the expense. The disposal, you are removing that PPE from the financial statement, again, at the carrying value. The revaluation that you have, that's the revaluation in the year. That's come from other comprehensive income. So you're debiting PPE, crediting your OCI. And then the balancing figure there is what appears on the statement of cash flows. Okay, because you credited bank, debited your property, plant and equipment. Okay, so that there is your purchase of PPE as an outflow. So put it in brackets. Okay. You then need to go through, so that's looking at the acquisition, the purchase of PPE. What about the proceeds from sale? Well, it's using that formula there, isn't it? Your profit or loss on disposal is equal to your proceeds less carrying value. You'll be given 2 of the 3. If it's not the proceeds that you're given, you will need to work that out. And those proceeds there will be your cash inflow. If you are given the proceeds, put them straight in the cash flow statement. It then may be that you need to work out either the profit or loss on disposal or the carrying value. Okay, if that's the case, the reason why you're looking to then work out, say, the carrying value is because that would then appear in the T account, being that figure there. And then if you're given proceeds and the carrying value, then your profit or loss on disposal will be the balancing figure. And that will be the figure that will then be adjusted within your operating activities. So you'll always be given 2 of the 3. It's then using the 2 of the 3 in the correct place first of all, working out the missing figure, and then using that where that figure is missing from. Okay, so you'll get used to it as you practice some of the questions. Okay, then what we've got, we've dealt with the proceeds from sale, we've dealt with the purchase. You can then go through there and work out, is it the interest received or the dividend received? Effectively, your interest received, your dividend received, that's your interest income. Okay, and that interest income would need to be adjusted for any opening or closing receivables in a T account there. Okay. Last little bit is going through there and looking at your financing activities. So we raise finance, don't we, from either is it debt or equity. So what you've got there, if you're looking at your equity, the issue of your shares is how we raise cash from equity finance. It's just the movement in share capital and share premium, because what you're looking at there is that you're debiting the bank, crediting share capital with the par value, and then crediting share premium with the excess, aren't we? And the figure that we're looking for there is the cash inflow as that debit to bank. Okay. So look at the movement in share capital, movement in share premium, and that's the cash inflow. In terms of your borrowing, so the debt, if we have issued debt, then there is an increase in your borrowings. So what we are doing there is we are debiting the bank, crediting our debt or our borrowings. So again, what you have there is that you have a debit to the bank. So there is an inflow. Okay, a cash inflow if you issue debt because you are borrowing money. Just note, if there is a decrease in your borrowings, that's because you are repaying that debt back. So you are debiting your borrowings or your debt and crediting bank. The credit to bank is a reduction in an asset, and that is therefore an outflow. So if you repaid the money, you have a cash outflow. Okay. And then just be careful, the dividend paid, it can go in operating activities if you so wish, alongside interest paid and tax paid. As a creature of habit, I've always put it in financing activities. You will not be penalised, provided you don't put it in investing activities. Okay. So to work out the dividend paid, you use your retained earnings, or alternatively, to get your dividend paid, you could just go through there and look at the statement of changes in equity. Okay, that will tell you the dividend paid. If you're not given the dividend paid within the question, just take the opening retained earnings as a credit balance, the closing as a debit ready to bring forward in the next year. You take the profit for the year figure from the statement of profit or loss. No total comprehensive income, including other comprehensive income, just the profit for the year goes to retained earnings, doesn't it? And then the balancing figure is your dividend paid, and that's what goes to the statements of cash flows because you've credited bank, debited the retained earnings. Okay, there we go. So that's a lot that's going on there with your statements of cash flows. So we've looked at the financing activities, we've looked at the investing activities, we've looked also at the operating activities. We now need to then start to think about how on earth would you go through there and approach that question. Well, let's go through and have a look at that in the next video.